So as promised, I'm going to go ahead and go over the 2019 sheet for the company we've been following now. The plan assets beginning and PBO can go ahead and be entered into the memo record as usual to get an idea of where we're starting from. 159,600. That's a debit balance, and then we have the $265,000 credit balance in the PBO. We have no new prior service cost, so we're not having to adjust the PBO by anything, and we can apply the discount rate directly to the beginning PBO to get the amount of interest costs that we would want to record. We have an interest cost of $26,500, service cost of $16,000. We can go ahead and put those in the pension expense column. This should start to be an old hat for the most part at this point, and then carry those over to the PBO. $16,000 will increase the PBO, crediting the balance and increasing it. Same thing for interest cost. Now, the actual return is going to be $22,000 this year. Remember, the actual return does decrease it, but we are looking for the expected return. So with that, when we add up these two, we want it to equal the expected return. Now let's look at what the expected return actually was. It's a 10% rate applied to the beginning plan assets. 15,960 would be what I expected to get. Now, what did I actually get? I got 22,000. So if my actual 22,000 is greater than my expected return of 15,960, then that means that my unexpected return turned out to be 6,040. And it was a gain because my actual was greater than what I expected it to be. So this is my unexpected return. And I would record that here. Notice that 22,000 credit and a debit of 6,040 add together to give me the expected 15,960, which is what I want to reduce pension expense by. I have some amortization of the prior service cost, 17,600. Because I am amortizing a cost, it's increasing pension expense. And for the first time, I have to check my corridor because I have a beginning balance here. My beginning balance stems from the OCI gains and loss account. It was at a $29,940 loss at the end of the year. Now remember, to check the corridor, we look at the corridor, which is 10% of the larger of these two. So 10% of 265,000. 10%, I think I said 20. 10% of that is going to give me $26,500. That's my corridor. I compare that to the beginning balance. The beginning balance is larger. If it's larger, that means it's too large. I need to apply amortization. How much amortization? Remember, it's not this amount, it's not this amount, it's the difference between the two. So 29,940 minus 26,500 is going to then, the difference between those two needs to be amortized. 27,940 minus 26,500 is $3,440. We're going to split that up over the average remaining service life, which I give you 20 years. So dividing that by 20 gives me $172. That's my quarter amortization. So I'm going to only reduce it by $172, yet I still am reducing it. So $172, I'm reducing an overall loss. That means I'm recognizing some of this loss, which means that I'm increasing pension expense by the amount I'm recognizing. And since I'm recognizing it here, I'm reducing there, right? That's the carryover so that this row zeroes out. The amortization of the prior service costs will also zero out against a reduction in that account. It had a beginning balance of $32,000. That is a 3. Looks almost like a 2. And then my pension asset liability had a balance I carried forward, $105,400, and that was a liability balance. So we put that in parentheses. Go ahead and make sure everything else is carried over correctly. The actual return should correlate to an increase in my plan assets of $22,000. The unexpected return is going to, since it's a gain, remember this is a loss, so this is going to credit. So since it credits, it's in parentheses. Even though that doesn't seem to make too much sense, it works. Zeroes itself out, zeroes itself out, zeroes itself out. Contributions to the plan were $27,000. That is a credit from the company's balance of cash to increase the plan assets by $27,000. And then we had benefits paid of $18,000. And if I pay benefits of $18,000, then that means I'm decreasing the PBO with a debit and also decreasing the amount of assets I'm carrying in my plan assets. And in this period, I had no actuarial movement. Oops, don't want to put that there because it wouldn't affect pension expense. If I did, it would go in here and here. Now we just accumulate pension expense column. That comes out to $44,312. My cash column, always a credit to cash or the contributions, should be used to that by now. When I take the balance of this account, $32,000 minus $17,600, that gives me $14,400 balance. It's still a debit balance, but it's decreased, and it decreased by $17,600. Gains and losses, beginning balance. Their ending balance would be $29,940 minus $66,040 minus $172. That reduces this account to a balance of $23,728, which is a change of these two items added together. That comes out to $6,212. And this is a credit effect, a debit balance. Now, finally, we total up the PBO and the plan assets. The PBO should come out to $289,500. The plan assets will come out to $190,600. The difference between those two tells me that it's underfunded by $98,900. And if it's underfunded, that means that I have a liability, which means that I should have a credit balance here. Now, I'm going from a credit balance to a credit balance, but this is a lesser of a credit balance, and so that means I have to apply a debit adjustment of $6,500. And again, I can take this information, write a journal entry, $44,312 pension expense. I could drop that up here. That's debit to pension expense for $44,312. The cash is $27,000. What else am I doing? I'm doing two credits and a debit. The debit was to my pension asset liability. $6,500. And then the credits are going to be to cash, to the prior service cost. So we have a credit to the AOCI prior service cost, a credit to the AOCI gains and loss account. To the prior service cost, that credit was $17,600. To the gains and loss, that's $6,212. And then we finally have cash of $27,000. That is the journal entry that would complete this problem. And of course, always be aware of what accounts and what amounts show up on the balance sheet. Those balance sheet accounts are right here. $14,400 debit balance in AOCI, $23,728 in unrecognized gains and loss AOCI, and a $98,900 liability for my pension liability. Of course, this would show up on the income statement, $44,312. All right. if you're getting the hang of it, then I would encourage you to pause the video before I complete the Martin problem. The Martin problem is just a different way of looking at it. I am actually having you solve for pension expense, which doesn't seem that foreign, except that I leave out a crucial aspect of the problem. So let's kind of start lining it up, and then but like I say, if you don't even want the lineup, go ahead and try to do it on your own. See where the problem is coming up, what you have to calculate, and then look at the key of the problem. If you try it, not doing too well, then maybe watch a little bit and watch the startup, and then look through the rest. Right? So we have a case here where I give you the projected benefit obligation and the planned assets. Really, it should be almost reflex by now for you to draw PBO of $1,500,000. Oops, wrong side. And planned assets of $1,700,000. Okay, so we got that information in there. We have an unrecognized prior service cost, which means that we have something. It's not a new one. It's a prior. It's unrecognized, the amount that's unrecognized. So that means that we have an AOCI account of $700,000 outstanding. We have a cumulative unrecognized net gain of $240,000. Again, this would correlate to a credit balance in an AOCI gains and loss account. Got average service life employees, discount rate, expected plan on return on assets, the usual suspects. So these are all January 1st, 2016, right? So all of these balances I just laid out, January 1st, 2016 amounts. Now, I say on December 31st, 2016, the actuary said the PBO should be $1,760,000. So if the year-end PBO should be that amount, that means that this is given by the actuary. Now, why are they telling me that? Because it says it's including a loss of $85,000. So they're telling me that there's an actuarial loss. Remember, if it's an actuarial loss, that means it's increased the PBO. So that happened during the year, sort of, or I'm going to have to recognize that loss during the year. The pension fund paid out $160,000 of retirements. So that is the benefits they paid. If I paid out, then I would have $160,000 there. I would also have $160,000 credit on my plan asset account. The actual return on the pension fund was 140. Well, that typically goes in my plan assets account. And it says Martin made no contributions to the pension fund. So that's zero. And then if we're thinking about, well, what happened? Remember, cash is going to be zero in my journal entry here. Because remember, we've seen it's always, at the very least, pension expense and cash. But cash this time is going to be zero. It says, assume that the 7-year average remaining service life applies to both unrecognized prior service cost and quarter amortization. What is pension expense? Well, what do you need? What don't you have? You can figure out basically every component of pension expense except one, service cost. How can you figure that out? Oh, look, you got some PBO that you can solve for. So now I would start and see if you can figure out the rest of the components of pension expense. Pause here and then review the rest of the tape. Or if you've already done the whole answer, let's keep going. So we're looking for service cost. That's a mystery right now. We can get interest cost. Interest cost is going to be the discount rate of 6% times the beginning PBO. So that $1,500,000 times 6%. That gives me $90,000 of interest cost. My expected return is going to reduce pension expense. I have an expected return of 10%. My plan assets are $1.7 million. And so that's going to turn into a $170,000 reduction, 1,700,000 times 10%. Right. What about my PSC amortization? Well, my AOCI PSC was 700. I say use this 7-year average for both prior service costs and corridor. So 7 divided into 700, that is $100,000 every year. That's going to add to pension expense. Now, students have asked before, well, Billy, why didn't you include the 700 in the 1,500 here? Because this is an unrecognized prior service cost. Remember, you only add this when it's initiated. This is just an unrecognized piece of it that's still in an account, right? We're applying amortization. Soon it's going to zero out. So this isn't a new prior service cost. It's an old one that was existing already at the end of the year 2015 in this problem. Okay. And in this case, I just told you to take the 7 years and divide it straight in there. And I'll tell you that, exactly how I want you to calculate it. And typically, remember, it is a straight line rate when we're talking about the prior service cost. The one that's not the straight line rate is the one we're about to look at, which is the corridor. Remember, the corridor is going to change from year to year. And we look at the beginning balances here. Which one's bigger? Take the 1,700 since it's bigger, or 1.7 million. 1.7 million times 10% gives me 170,000. And now we have to compare that with the beginning balance, 240. Well, since that beginning balance is bigger, I have to apply corridor amortization. I want to do it to the difference of those two, 240 minus 170 tells me that the difference is 70, and I'm going to divide that again over the remaining service life, suggesting corridor amortization of 10,000. So that's my corridor amortization. Now the question becomes, is this positive or negative? Well, this is a gain balance, and if I'm recognizing a piece of a gain balance, then I am going to be reducing pension expense by the amount of the gain I recognize. Okay. I'm recognizing 10, I'm leaving 230. Well, the 10 that I recognize is going to reduce my pension expense. Well, now I'm still not getting pension expense because I still need service cost. The way I can find service costs is by solving in the PVO, right? I have all the other pieces laid out to properly value this. So remember what else goes in here. Any money I paid out is already taken out. The actuarial loss is already accounted for. Interest costs would go in here, and the only thing that's remaining now is service cost. And so I solve this equation for service cost, which is that 1,500,000 minus 160 plus 90 plus 85. Without any service cost, that gives me 1,515,000. I want a balance of 1,760,000. The difference has to be that service cost of 245. Now I can solve for pension expense. 245, $90,000 of interest cost, $170,000 expected return, amortization of the prior service cost, and corridor gives me $255,000 pension expense. Now can I make the pension expense journal entry work? Well, $255,000 pension expense. What else? Well, I had a change of $100,000 in my PSC. That would have to be credited. We have to see what else happened in AOCI. If I have an actual return, 140, and an expected return of 170, actual of 140 minus the expected of 170. Well, since I expected 170, I only got 140. That's a $30,000 unrecognized loss. None of this was asked for by the pension expense, but just filling in the blanks. If I have a $30,000 unrecognized loss, that's going to decrease my AOCI account even more. And so actually, after I consider the quarter amortization and that difference between the actual and the expectations, I'm going to end up with a $200,000 balance overall. And that's a $40,000 debit. Ooh, and I forgot one other thing. I have to include the loss. And so that's actually going to reduce this further because that's an actuarial loss of $85,000. That will reduce my account to $115,000. So my AOCI account will be $115,000 gain position still, but greatly reduced. It was reduced by an overall amount of $125,000. And so I debit the AOCI gain and loss account by that amount. The only thing that's remaining now is my pension asset liability, which of course is always driven by the difference in my PBO and my plan assets. I have my PBO balance. I need my plan asset balance, $1,700,000 plus 140 minus 160 gives me $1,680,000 of a balance in my plan assets. That would create a pension asset liability. The difference between these two, assets, liabilities, it is underfunded now by $80,000. When we started the year, it was overfunded by $200,000, the difference between these two. And so now we have a $280,000 adjustment to the account that would have to be made in our journalization of the reconciliation of pension expense. And yes, debits equal credits. Now, again, remember, what are the balances here? The balance is a liability of $80,000. The balance is a credit balance in my AOCI of $115,000. Sorry about the mess here. Just including the actuarial loss, the corridor, and the unexpected return. And then the balance for my AOCI PSC is $600,000 debit. So we've been talking about pension expenses this whole time. There's another very related item, which would be post-employee retirement benefits. OPEB is sometimes how you'll see it as an acronym. So these might be healthcare, life insurance, any legal services provided by the firm after retirement. We're going to look at healthcare benefits in particular because they are a tremendous obligation, about $500 billion across the US. OPEBs are typically underfunded. Pension plans are typically overfunded. So these OPEBs are very similar to pension plans, yet the nature of what we're covering is very different, which gives rise to the difference in trends we see. So the amount of benefits are generally fixed with the pension plan. Remember, we're talking about defined benefit plans when we're talking about sort of pension plans. We've been speaking about the complex ones. And so if the benefits are defined, it's pretty concrete. If management wants to change them, then we have a prior service cost. But for the most part, we have these locked in. Under healthcare, it's generally an all or nothing. Also, under the benefits, the amount you get is correlated to the amount of time you stay at the firm. So if you only have a 5-year tenure, you're going to get a lot less in terms of benefits compared to someone who's been there for 20. With healthcare benefits, typically it's an all or nothing. If you've been there for 10 years, you get total coverage. If you've been in there any less than 10, you get nothing at all. They don't cover 40% of your medical costs after retirement if you've been there for 4 years, let's say. Like I said, the nature of the benefits are well-defined, paid monthly. It's a defined benefit. And for healthcare benefits, they are uncapped, variable, right? The sicker you are, the more is paid. So this is not something that is easily estimable. The coverage is going to be to the retiree, to the person who was employed, and maybe some to a surviving spouse. With healthcare benefits, it's everybody, right? It's the retiree, their spouse, their dependents, etc. Funding, like I said, pensions generally well-funded, generally have a plan asset that is greater than their PBO. On the other hand, these are generally not well-funded because there are no tax-deductible contributions. Over here, contributions are tax-deductible, which makes a lot of difference. Also, it is generally harder to establish more ambiguous, more uncertain benefits than it is these defined benefits. Aside from those differences in terms of coverage, remember the all or nothing, the more inclusive spouse and dependents, the uncertain nature, there are some other items that we use a little differently. For example, the primary obligation measure is the APBO for healthcare benefits. It's very similar to the ABO. So remember, we have the PBO, the VBO, and the ABO. This was 100% vested, no future salary. Well, future salary is a little bit less indicative of how healthcare is given by employers. And so they assume 100% vesting, and the salary benefits don't necessarily really mean anything to what your obligation will be. Whereas when you are calculating a pension, the benefits you receive are very tied to the amount of salary you were paid at the firm. And so pensions use the PBO, and OPEBs tend to use the ABO. I mean, they call it the APBO, but it's comparable. And when they are looking at how to calculate service cost, the actuary is going to use the EPBO, which is comparable to the PBO, in order to do that. And again, it's generally a very similar process where we have interest costs that goes into the pension expense. For OPEBs, we have interest costs that arise from the obligation to deliver an OPEB. And so a lot of those are going to be the same. Quarter amortization, the amortization of PSCs, all that sort of thing is going to be basically the same between those sorts of plans. I wanted to look at one other thing, and this is from a very old annual report, 2006. It's taken from GM's annual report. And as you can imagine, GM has a rather sizable pension obligation. And their pension obligation, it says the projected pension obligation for December 31st, 2006 was $85 billion. So they have to provide $85 billion to their retirees, rolled back to a present value. Now, remember, all this time we've been talking about the discount rate and the expected rate of return, but we haven't really discussed what effect these things have on pension expense, or what effect they can have. And with the discount rate, it gets a little involved. With the expected rate of return, it's really straightforward. If, for example, our 6% rate tends to be wrong, and it's actually 5.75, well, then what's that going to do to my pension expense? If the 6% expected rate was wrong, and I really should use a 6.25 rate, what effect would that have on pension expense? Right? So what are the effects of guessing wrong is what this table lays out. And this is from, this is a disclosure made by GM about how these estimates would affect their income and the PBO. So looking at the expected rate of returns, if my expected return on the assets were less, that means I have, if my percent is going down, then that would imply that I would have less of an expected return. If I have less of an expected return, then that means that pension expense is going to go up. Remember, because expected return decreases pension expense. If we think about how pension expense, as expected return goes up, that means that pension expense goes down. Well, if expected return is going down, then that's going to mean my pension expense is going to rise, which we see here. It says that if I'm just off by 0.25%, it will cause pension expense to rise by $230 million, which is quite a lot of money. Right? Also, say that I have an increase in my expected return. How's that going to affect it? Well, if my expected return is increasing because I have an increased amount being applied to the plan assets, that's going to lead to an increased expected return, which is going to be subtracted from the pension expense, which decreases my pension expense. So yes, that also makes sense. So increases in the percent applied to the expected return increase expected return, which implies a decrease to pension expense. Great, you might say. So now let's take that and just apply it to the discount rate. If the discount rate goes down, then you say, well, that probably means interest cost goes down, right? Because the discount rate times the PBO gives me interest cost. This is true, but the discount rate affects not just itself, but also the PBO. Remember, the PBO is the present value of obligation. So we're using the discount rate. So what happens to a present value if the discount rate goes down? That implies present value goes up. If present value goes up, that means my PBO is increasing. The effect of the PBO increasing will far outstrip any amount that decreasing this would have on interest cost. So the change in the PBO is what rules here. If there's a 25-point decrease in the discount rate, this drives up the present value of the PBO, which actually makes it so that there's an increase in pension expense stemming from interest cost rising. Even though there was a decrease in the discount, the present value of the item rose so much. And just the opposite in the case of a decrease in the discount rate, that's going to have such an effect on the PV of the PBO, it's going to decrease it to the point that overall pension expense will decrease because interest cost will decrease. Notice the difference here. $2 billion of an effect on the PBO. That means that 0.25% of a rate affected it by $2 billion, whereas it only affected the pension expense by 110. Okay. So a counterintuitive effect you really have to puzzle through, and the reason it makes sense in the end is because of the time value of money and the relationship between interest rates and present value. That should be an association mark, but that didn't come out too well. All right.